Most people hear the words financial statements and immediately want to change the subject. They seem boring, complicated, full of numbers that mean nothing to someone without an accounting degree. And yet, if you want to invest in company stocks, being able to read even the basics of a financial statement is the difference between investing with knowledge and investing with luck. Today I will show you that you don't need a degree or hours of study. You just need to know where to look and what to find. In 10 minutes, you will have a completely different perspective. Every publicly listed company is required to publish its financial results on a regular basis. These documents are available for free to everyone, and they contain three main parts. First, the income statement. Second, the balance sheet. And third, the cash flow statement. Each one tells you something different about the company. Together, they give you a complete picture of whether the company is healthy, whether it is truly making money, and whether it deserves your trust as an investor. This is the most well-known of the three statements and the best starting point for a beginner. It tells you simply how much the company earned, how much it spent, and what was left at the end. The first line you look at is revenue. This is the money that came in from the company's sales before anything is subtracted. Then you check whether that revenue is growing over time. A company that sells more every year is a very good sign. Next, you move down to net profit. This is the amount left after paying employees, operating costs, interest, and taxes. If revenue is going up but net profit stays flat or falls, something is eating into the earnings from the inside. That is worth investigating. One of the most useful numbers you can calculate yourself is the profit margin. You divide net profit by total revenue and multiply by 100. If a company has revenue of 100 million and net profit of 20 million, the profit margin is 20%. The higher this number, the more efficiently the company operates. Companies with consistently high profit margins usually have some competitive advantage that sets them apart from the rest. The balance sheet is like a photograph of the company at a specific moment in time. It tells you what the company owns and what it owes. The first part is assets. These include cash, inventory, buildings, equipment, and anything else the company owns. The second part is liabilities, meaning debts, loans, amounts owed to suppliers, and other obligations. The difference between the two is the net value of the company, which belongs to the shareholders. The first thing you look at on the balance sheet is whether the company has enough cash to cover its short-term obligations. If debts are much larger than cash and liquid assets, the company could find itself in a difficult position if the market turns tough. Debt is not bad by itself. Many companies borrow to expand, buy equipment, or enter new markets. What matters is whether the debt is manageable relative to earnings. A simple way to check is to see how many years of profit the company needs to pay off its total debt. If the answer is 2 or 3 years, that is fine. If the answer is 15 or 20 years, that is a serious warning sign. This is the statement that many beginners skip, but it is perhaps the most important of the three. Why? Because a company can show profits on paper while having no real cash in its accounts. This happens because accounting allows certain entries that do not correspond to actual movements of money. The cash flow statement shows you the real cash that came in and went out of the company. What you are looking for here is something called free cash flow. This is the cash that remains after the company pays for the investments it needs to operate. If this number is positive and grows every year, the company is in a very good position. In practice, you do not need to read every page of a financial report. it is enough to check 5 key points. First, is revenue growing every year? Second, are profits stable or trending upward? Third, does the company have enough cash relative to its debts? Fourth, is free cash flow positive? And fifth, do I see any trend that worries or impresses me? If 4 out of 5 are positive, you have a company worth looking into further. If most are negative, there is usually a reason the stock is cheap. Analyzing financial statements is not an exact science. It is a skill that improves with practice. The more companies you look at, the faster you recognize what is normal and what stands out. Start with a company you know well, one whose products you use in your everyday life. Find its financial results, which are always free online, and apply what we covered today. You will be surprised how much you can understand in less than half an hour. If you found this video useful, like and subscribe because every week we upload new content that helps you invest with more knowledge and less stress.